Welcome to Indiachrts. We've closed the month of July 2013 and the month has closed down. What makes it interesting is it follows a negative month even for June, so we gave up most of the intra-month gains and it further pushed the monthly momentum indicators into the sell side, something that's happened after more than a year. So that puts aside a very interesting point for the market as it enters the next most significant leg that should last for the next couple of months. We are also now in a very advanced stage of the Kondratieff winter cycle where we are seeing most sectors begin to give up and you just have probably one or two sectors which are holding up the indices, and once that is complete, then probably you see a much more widespread decline through this part of the cycle. So we are at that point where you start getting a very broad-based setup for the downside. In the interim, one of the main issues that has faced the market has been the USDINR, and just a week back there were several measures that were taken to actually reduce volatility, but if you look at them, they actually work the other way completely. And that's what you saw in the last 3 days, that after expiration you've seen a very fast move on the upside. One logic that I can think of why this happens is it's very similar to what you saw in the bear market of 2008, where short sales were banned in equities in some countries. In fact, in India itself we've seen the ban on Badla happen several times, and whenever we do that, what you see is a complete loss of liquidity in the markets, and then any kind of buying or selling that comes in pushes for prices much faster up and down because depth does not exist. Now, as it is due to lack of investor participation, you have a lack of depth as far as Indian markets are concerned. Now you're seeing actions being taken to actually take depth away from the futures or derivative segment of the currency market. So by actually putting limits, by actually raising margins and all such measures, you're really reducing liquidity from the markets, and that's been seen in the day-to-day trading volumes, which had jumped up to almost 40 lakh contracts a day, and now it's down to less than 10 lakh contracts a day. That's a 75% fall in the daily trading volumes on the NSE futures for the currency. So that's what we've seen. So it really didn't make sense to me. Even the moves that RBI did to really raise interest rates does not address the real problem with the underlying currency. It just addresses short-term adjustments, and they've themselves accepted that in the monetary policy, saying that the government really needs to do something on the real issues that face the economy if whatever RBI is doing has to work. So in a sense, they realize that these measures by themselves are not sufficient to really change anything. So they would end up being essentially short-term measures. My view essentially has been that the currency USDINR has been in a bull market since 2008. The reasons for the move keep changing. The Elliott wave structures have been very clear that a larger bull market started from back then, and each leg up appears as an impulse and has a long way to go as it continues to subdivide, something that would last for at least another 2 years, if not 3 years. And so it's likely to be an ongoing affair month after month. The reasons may keep changing. The move initially started on the back of the global financial crisis. Later it shifted towards the European crisis. Last year we had problems with FCCBs. This year we are talking about CAD all the time. So the reasons might just keep changing as to what is affecting the currency. But it's a huge anomaly when you really look at countries like Japan, where weakening your currency is actually being taken positively by markets. In fact, even when India started its first round of reforms, one of the significant steps was to depreciate your currency, and that was at that time very good for the market because you were looking at enhancing your exports and being able to attract more capital. Today we face a very different situation because after years of attracting capital, we are really questioning the ground realities that are there in the economy, and whether significant changes have happened in terms of your competitiveness, your attraction of investment capital and FDI and so on. And if those core issues have really not changed, then we are still not past the point where we can say that our currency is fully convertible, and that puts you in a tricky situation when you start questioning the past. And a weakening currency, which is really today a global theme. It's not that the rupee is weakening against the dollar by itself. It's happening across most emerging and key currencies where money flowed during the boom years of the last decade, whether it's the Australian dollar, Brazilian real, and many other currencies that were also seeing a rush of capital that was moving away from the US, whether it's Singapore or it's the Swiss franc. So all of them have started to weaken against the US dollar. So the movement of the USDINR is really not independent of what is happening around the world, and thus our feeling that this is not good for us is essentially because we've attracted a lot of hot money, and we really continue to have issues of the past. Otherwise, a weaker currency could actually be taken well in terms of competitiveness and growth as far as India is concerned. But at this stage of the Kondratieff cycle, it's actually being taken negatively. At a much more advanced stage, once the bear market has really run its course, something that I think is likely to start with a much more broad-based decline, as I mentioned earlier, where the few couples of sectors that have been holding the index up actually give up, similar to what you saw between 1999 and 2001. When you enter that stage, it's during that time that the thinking would actually change from trying to deflate, which is what we are really doing as far as India is concerned. We are really reducing our debt to GDP ratio at the public level, and the pressure on credit in the banking system remains. So that really is is actually leading to a deflationary trend in India. And it's at the end of that when the need to start reflating again comes in, that weakening your currency will be actually taken as a positive measure, which is good for the economy. We've not reached that point yet, so the reasons for the movement in the currency would keep changing as we go along throughout the cycle. What's also started happening and might continue for some time is the pressure that we are seeing on interest rates. I had mentioned and shown a chart of the 10-year bond yield for Indian G6 in my original Kondratieff cycle reports, which are still on the website. And when you see that chart, you see that the entire post-2001 moves have been corrective on the way up, and it's a large ABC upward move in the rates. First you saw an uptick in rates after 2004, then you saw a big decline in 2008-9, and then after that you've seen rates move up again. Now it started looking like rates were declining, but we'd really not touched the upper channel line target for the bond yields, which are closer to double digits, which is what I mentioned, and one spike to double digits appeared to be pending. Now we've just seen the first round of pressure on rates because of the currency environment, and it's possible that either inflation or the currency environment, either of them, continue to put pressure on interest rates for some more time. And I wouldn't be surprised if we actually see double-digit yields on 10-year bonds before we actually get a reversal on the interest rate side. And that's when the Kondratieff cycle will really end as far as the Indian asset prices, stock markets and the economy is concerned. So we'll continue to be under that deflationary pressure. And if any of you really studied or read the works of Proctor on deflation, and he's and many other authors who've gone into a lot of detail as far as what has happened in 1920s and 30s and expected it to repeat in the US, then you'd actually start seeing similarities between what happened through the 20s and what happened in India, where asset prices got reflated by low interest rates and low inflation in the autumn bull market cycle, and eventually deflated after that as measures were taken that actually put pressure on the system. And then once that cycle was run through, then markets started recovering. The deflationary process lasted for much longer than equity prices bottomed, and much later it was considered that the deflationary cycle from the economy's point of view also ended somewhere in the late 30s to early 40s. So why has this not? Why are there similarities between what is happening in India, but it's really not showing up on the US, which is where most of these studies were made? It's simply because the US is ending a much longer term cycle, not just a 70-year cycle, but a grand super cycle, a series of 3 super cycles from the 1970s, from the 1750s. That's almost more than 300 years back, and it's because of that that maybe it's taking much longer. That's one logic, and the much more another form of reasoning that you can take is that just like analysts and students have studied that time period and expected the same events to repeat, the government to take the same actions and the Feds to take the same actions, the Federal Reserve itself appears to have studied that environment and decided to do exactly the opposite of what they did back then, and that has resulted in completely different outcomes, at least in the near term, for the last decade. That's probably the key reason why it's taken so long to really see the effects that have been forecast by so many authors. That you have two groups, one who's forecasting and the other one that's actually taking action, doing completely the opposite of what the forecasters are expecting them to do. Although they would expect that at the end of it all, the excesses that have been blown out of proportion will, by nature themselves, come back to what is really needed, for the system to correct itself and resume a fresh journey. So it's likely to be a much more long-term process as far as the US market is concerned. In fact, if you see the last grand super cycle data points, it lasted for 20 to 30 years of a cyclical bear market in the US way back in the 16th, 17th century. And while most people don't expect it to be that long, I really wonder how long a time period of a cycle of that time frame is taking would really impact US markets. But when it comes to India, we are probably in a much smaller degree a bear market cycle. It could last for a couple of years if we allow it to unwind fast, which appears to be the case so far. Otherwise, typically it could last even for 10 to 20 years, but I don't think that's likely to be the case. I think a couple of more years, and as far as India's cycle is concerned, we would have unwinded the Kondratieff winter cycle in India. But like I said, I can find complete similarities between what has been written on deflation in Pector's work and what I actually see happening in India in the same sense. The impact of social mood, the same kind of measures that were taken by various government agencies, and I think what you will end up with is with very similar outcomes. And once we are through with the deflationary process, when credit really comes under pressure, when rates have moved up quite a bit, then you'll probably see the monetary authorities again and the government try to reflate the Indian economy. And I think at that point you would see interest rates start falling, and probably the equity markets and real estate markets bottom out. So I can't really put a time frame to it, but I think it's a couple of years that we're going to see this around. And for this year, I think we're likely to remain in the bearish phase that has started from Jan or from May for the next 2 to 3 quarters.